The period of globalization is ended. You need to build multiple supply chains, redundancy, new manufacturing systems, and all of that. Why aren't people putting money into it? They won't. It wasn't the great returns in the 70s that got people to put money in the space. It was shortages. It was lines. People don't buy these stories until you run out. That's going to hit middle-class America and change their lifestyles like they've never seen before. And you have the abundance illusion that the Western governments are pursuing that make it more difficult. I think it will take the actual shortage to get people to move. And then we get the capital move, and it's a different ballgame.
Today, I'm joined by energy commodity analyst Jeff Currie for a deep look at the relationship between financial and physical energy and commodity markets and how that informs the energy supply that will be available to us in the coming months, years, and beyond. Jeff Currie is the Chief Strategy Officer at Altus Partners. Previously, Jeff served as Chief Strategy Officer of Energy Pathways at the Carlyle Group, where he currently serves as Senior Advisor to the firm. Jeff is also the former global head of commodities research at Goldman Sachs, where he helped to build their commodities business. During his nearly 3 decades at the firm, he became one of the leading commodity market strategists on Wall Street, known for advising clients through the commodities supercycle of the 2000s, the shale supply shock of the 2010s, and most recently, the twin shocks of the pandemic and the Russia-Ukraine war. Despite getting our graduate degrees from the same city and starting on Wall Street in the same year, and both having an energy systems perspective, this was our very first conversation. We talked about the magnitude of impact the Iran-Hormuz situation will have on the West and on the world that is still mostly being discounted and ignored in financial markets. We talked about the importance of diesel to our economy and how close we are to physical product shortages. We talked about debt and the decline and fragmentation of globalization and an inevitable shift towards state capitalism to coordinate the needed infrastructure investment. I expect Jeff will be back on TGS. This was a great initial conversation. If you are enjoying this podcast, I invite you to subscribe to our Substack newsletter where my team and I share written content related to the Great Simplification. You can find the link to subscribe in the show description. With that, please welcome Jeff Currie. Jeff Currie, welcome to the program.
Pleasure to be here, Nate. So I'm looking forward to the discussion.
We have a lot to talk about. You have spent 3 decades at Goldman Sachs as one of the leading commodity strategists on Wall Street, advising clients through the super cycle of the 2000s, the shale supply shock of the 2010s, the pandemic, the Russia-Ukraine war, and now, mid-2026, and I will timestamp this, Thursday, July 23rd recording. From your seat at Carlyle, you're watching the Iran war, the disruption of the Strait of Hormuz, this morning, the Ansar Allah attacks against a Saudi tanker. I have a lot of questions for you, but before we get into the details, from a wide boundary angle, how do you read this moment in the history of energy? And is this another cycle, or is it something structurally different?
I mean, there's a cycle going on, and I'm not going to talk about that. We'll spend most of the time talking about the cycle, but I think just from an initial knee-jerk reaction, it's like, okay, macro community, you weren't worried about the Straits of Hormuz. So what did we do? We shut the Red Sea. We have shut the Black Sea. We've taken out half of the refinery capacity out of Russia. So if that wasn't good enough for you, is this one good enough for you? And you still see the market struggling to hold $100 a barrel at this point in time. If you would have given me that scenario 2 years ago, I'd say, global recession and we're in deep, deep trouble. And by the way, the product prices are telling you're in a deep, deep trouble. But, I like to say crude is the noise, products are the signal, but people are not looking at them. But when you look at crude, the reason why everyone is convinced that Trump will taco. The problem I have with a taco is what is he going to try? What can he pull out of the hat to taco with? He had the MOU before he could pull out of the hat to taco with. And at this point right now, the terms of any taco would be far worse than the previous one. And, I view that he's now being driven by his I don't wanna get in the mind of him, that's not where I ever like to go. But I find it really difficult to believe that it could be an easy taco, and also the magnitude of this disruption, I mean, it's like you couldn't dream this up. And, the market just is again shrugging it off just like it has the entire time.
Well, this is why I'm been so looking forward to talking with you, because you're one of the few people from back in the day. By the way, I told a bunch of my remaining Wall Street friends that you were coming on the show, and they were like, "Oh my God, he's the king of commodities, and he's often early, but he's always right." So I'm just wondering, what is it that you're always going to be right about and possibly early right now?
By the way, I'm gonna disagree with that. Commodities are the best performing asset class this decade. You're up over 200%. Crypto on average is 157. I just wrote an op-ed, so I got these on the tip of my tongue. We called the bullish super cycle in October of 2020 in commodities. That's when we made the call. From that point forward, since October of 2020, commodities, bar any other assets, the best performing one. And the reason why the bottlenecks may have changed over that time period, but the trend in commodity returns has not. So it was oil earlier this year, and it's diesel today. Because remember, diesel products are up like 81% year to date. The index is up like 34. The second best performing equity group is um, the energy equities. I think the reason why people believe that is that they look at the price level itself and not the returns generated. And what is different about this cycle than in the 2000s is the returns were generated with the price going up like this. This time, it's that front end of that curve. You're rolling the front end of that curve and generating significant returns. So even before this recent rally in crude, when we were sitting at $75 a barrel or whatever, I think it got a 60 handle on it. When we're at $60 oil, the investment returns for being long oil, even though it was lower than when the war started, during the war were 40% because you're capturing those spikes going up and down over that time period. And the point that I made is I don't care, and we'll talk about, and this is something I really want to get is, returns from commodities can come from either the shape of the curve or they come from the price appreciation itself. Think of it, it's either from the dividend or from the roll yield is what we call it, or it comes from the price. The bottom line is it generated massive returns for anybody who actually held them. And before oil, it was gold, before copper, before nickel, before silver. Keep going down the list. Coffee, cocoa, livestock, oil during the Russia-Ukraine. And I think that that's what's being missed. And there's too much of a focus on the price level. By the way, I was super wrong in the 2000s because the price level went up. By the way, the returns were terrible because you had a contango in the front end. So what happened is the back end drove up the curve. You're rolling that front end and just destroying any return potential. I don't know what it is, but the bottom line, the returns from holding hard assets have been absolutely phenomenal this decade.
So you and I started on Wall Street. I went to Salomon Brothers. You went to Goldman Sachs the exact same year. I managed money for billionaires back then. That was my job. And one of them started trading oil futures. And so as a good broker, I learned the ins and outs and the special qualities of oil. And I realized a barrel of oil can do 5 years of human labor. And oh my gosh, this stuff is depleting. And it's made from fossils over millions of years. And so I started to view the world from an energy lens, thinking I was a year or two ahead of the pack. And here we are 30 years later, and I don't think Wall Street still understands that oil, diesel, jet fuel, and the like are the hemoglobin in our global system. And they look at things that can just, oh, we'll print money and it'll be fine, or we'll guarantee this. And I don't think there's a plan here. I think we're bombing without any coherent plan. And you're right, there isn't a plan. So to me, I felt strongly since February that we kind of hit our aircraft carrier hit an iceberg, and the bottom compartments are filling with water, but the grocery stores are still full and the gas stations are still full. So bring us up to speed on why we've been so complacent about this. And I think some of it is a financial lens and not an energy and material lens. And some of it is we've been drawing down storage both in the US and China and elsewhere. Where do we stand today on the oil storage price situation?
I think that in products, you're already there. We are at critical levels. If we look at the 3-2-1 crack spread, which gives you a 3 weight to gasoline, a 2 weight to diesel, and a 1 weight to crude oil. Thinking about it's the value of the products versus crude oil. It's $60 a barrel. That's the highest level in the 3 decades I've been doing this. I've never seen it this high, and no one has, which is telling you at $100 a barrel, the products are at 160. And so when we think about what happened to get us to this extreme shortage in products, it has to do with we've knocked out refineries in the Gulf, in the Arab Gulf, and we did not send out products when we had the ability to send it out. We sent out crude. You should have been sending out products, but you can't send out the products because the ships are flammable. They blow up. You bomb a crude tanker, as you saw in the videos earlier today with that Saudi tanker. Yeah, it catches fire, but it's not a bomb. The product ones are. And then China, everybody goes, oh, it helped out Trump and kept prices down. Well, they cut refined product exports and they cut refinery runs. They drew down their product stocks. And so when we look at what China's actions did, it made products tighter. It made it backed up some of the crude, but it made the products tighter. Then we had Ukraine striking 1,300 kilometers into Russia, taking out nearly half of the refining capacity. And now they're importing jet fuel from Japan and diesel from India. They're supposed to be the largest product and crude exporter in the world, and they're importing. And also, people go, oh, it's just bullish products. No. When you think about those refineries, these are Soviet era refineries. There's one pipe of crude going in. You shut the refinery down, you're shutting in the crude. So we've lost the crude as well. So we think about the U.S., it had the SPR, and basically it was trying to turn product in as fast as they can to send to Europe. And we're now getting to the point the draws out of the SPRs are in that 3 to 5 million barrel range per week. So we're in a very different environment on products than we are on crude. We may have a few now if we take out the Red Sea. And by the way, the Ukrainians were also taking out the Red Sea or the Black Sea. So Ukrainians taking out Black Sea. The Houthis taking out Red Sea, Iran taking out Straits of Hormuz. We have China back to increasing refinery runs to export product because at $60 a barrel, it's a no-brainer. We're now going to shift that shortage into the barrel of crude as opposed to just the product. So, we may have a few, let's call it 30 to, 60 days of excess oil, given the magnitudes of these disruptions, but it won't take time before that crude situation evolves into something bigger along on the product side. So your point about it's like the Titanic, where the iceberg is broken, we're filling it, and everybody is sitting, and going, oh, nothing to worry about. And also, we look at Western governments; they just reinforce that. And that's part of the reason why the macro community just won't buy this thing here. They're not doing it. I think they may, when they do, this thing, it's going to take an express elevator straight up. Now, I think is one way I said it previously, the conditional probability going to 150 once you get over at 100 is pretty high, unlike it was before. Because of your point, the shelves are emptying fast. There's not a lot out there. And I think at this time, people will look at the probability of a taco is much more difficult because the one thing he could always taco with, he always could pull the rabbit out of the hat, go, hey, here's the MOU. They actually can supply us with crude. They're not going to supply him with crude this time around.
I think this is going to be akin to Napoleon's Waterloo in retrospect, because there is no, every week that goes by, Iran has more leverage in the situation. I just don't see a good outcome here, and I think this is going to reverberate forever. I mean, even if the war ended today and we went back to full peace, which is highly unlikely, what about the damaged wells in the Middle East that have water fill and other things that they're going to have to restart? What about the negotiated contracts are going to go to the east instead of the west on a lot of these products? What about the instability in the Middle East? What if Saudi, and the U.S. attack Yemen and that conflagration starts? Any thoughts on all that?
Add in Russia shutting in the wells. There, the water cuts are bigger, older. Their ability to restart these things, and from my understanding, is the Ukrainians hit those CDUs just bang on. It's going to take 1.5 years to rebuild these. You shut down that CDU, you're shutting in the production. And roughly 35% of that can be redirected. So everything you just said applies to the Middle East as well as Russia, the two largest oil suppliers on the planet Earth. That's why it's just it. And everybody got bearish after that MOU. I'm going, what planet are you guys living on? Look at the crack spread, $60 a barrel. You were already there. So I'm beyond myself of the complacency.
Seriously, I mean, you and I know this stuff quite deeply. And if 6 months ago, in January of 2026, someone had told us this scenario, it would have been close to an Armageddon scenario. I've been using Hormuz as a graphical example in my presentations on energy as the lifeblood of civilization for over a decade. And here we are. And yeah, oil's up 5% today to 80 some dollars. I mean, it's the complacency is bizarre, which is why it's comforting to talk to someone from Wall Street like yourself that understands what's going on under the hood. So let me ask you this. You've described the drawing down of strategic petroleum reserves as liquidating a buffer that's built up over decades in order to suppress the very price signal that would trigger the necessary investment response to what the market needs. Can you play that forward for us, Jeff? What actually happens when those buffers are gone and the signal finally comes through? What are the mechanisms? What actually happens?
The reason why we have futures markets is so that they can try to buffer us from high risk environments, in that you would have entities, going out like airlines, buying, and it would bid it up slowly and buying oil to hedge out the risk of something really bad happening. In fact, what we find in doing studies is that markets that have futures markets and ones that don't, the futures ones anticipate events. They're driving down, they see the pothole, they drive around it, and then they don't run into it. The ones who don't end up with huge spikes. And the example we give are onions futures. They were a target of Gerald Ford, the president back in, and he was I think he was a representative or a senator from Michigan, actually your neck of the woods, back in I think the 60s. And he banned onion futures. So we showed what he did. It created an environment in which you can't avoid the pothole, and the onions would go straight up and it's come spiky. And I think the issue here is that we're taking out that price signal and that gradual. So another one I like to give is Newcastle coal, which is more in our career. Is you remember what happened in Newcastle coal right before oil, and like it was in late '08. It sat there and did nothing through that whole super cycle because it couldn't price anything in it. It hit the pothole and just went straight up. Absolutely explosive. So there's no anticipation.
Let me ask you this, though. Obviously, there's a long forward futures strip for both natural gas and oil futures. But my understanding is that 98% of the liquidity is in the first 6 months. And if an investor or a big business wanted to hedge and buy a lot of oil futures 18 months out, there's no liquidity there. So the only way to buy large quantities of oil in the future is to buy an oil company, maybe. What are your thoughts on that?
100%. And that was a direct result of Dodd-Frank. take out. So the ability to manage this. In fact, you just reminded me, I wrote this op-ed that was published this morning in City AM. I called it the physical capital paradox. Best returning asset class and nobody owns it. And I think let's go over a few reasons why. And as you just said, it dawned on me, it was Dodd-Frank. I didn't include it in the list, but one I talked about in there was as a share, it shrank so much because of the sustainability issues earlier this decade. You look at energy, it's running around, just shy of 4% of the S&P. Basic materials, put them together, you're under 6. It's a third of the long run average. But let's just take the 3% for energy. Let's say energy doubles in value, 100% return. At 3%, that's a 6% return to the portfolio manager. Take tech, 53%. So let's just round it at 50. To equal the return that you would get in energy of the 6%, it only has to go up 12. So you can see. Actually, I got it backwards. 100% at 3% is a 3% return. 50% of a 6% return is 3%. So you can see the bar for tech is pretty low, and you wonder why everybody's complacent. They don't want this happening, because they're so underinvested, their returns will get demolished like they did in 2022, and they seem to have forgotten that. And I think that's one of the big issues. But going back to your point about, the Dodd-Frank, there's no capability to manage that risk. I mean, the old days that you and I grew up in Wall Street, where they were running huge positions in taking proprietary risk. In fact, the joke that somebody said to banks to me, you go out for lunch, your quote on copper is no good by the time you come back. In the old days, they would come in, and because it was execution was the primary focus of these banks, not price. And because it's become price, they can't take that risk out there. There's nobody taking the risk. Therefore, the ability for people to extend, whether if it's credit or anything out into those further dates are not there. Because remember when I said I was wrong in the 2000s because the curve went up on the back end? It's your point. People had the liquidity out there. They would buy it. And this time around, they're not.
So you're foreseeing some potholes ahead.
Huge potholes, massive potholes. Again, I'm going to go. People say I'm wrong, and by the way, I hear that all the time, so I don't take it offensive. But we are already we got to $5,500 gold, and we are at what, $4,200 this morning. We're at $160 diesel. We are at $101 a barrel Brent. We are at $14,000 a ton copper. The list goes on. We've already hit some pretty major potholes, but the ones coming up are going to be massively larger than the ones. In fact, the way I said it previously, we're only in the foothills of the Himalayas at this point. And by the way, the other thing too is what made that very different in the 2000s is that point you're making. We're buying the back end, so it was much smoother. Because there's nothing on the back end, it's like this, spike after spike after spike, and it doesn't feel like a trendy market, so people don't buy into it. But this time around, I think the upside in these spikes, when we just hit the potholes and go in and come back out, is going to be really significant.
So this is our first conversation ever, even after being in Chicago at the same time in 1992. So I don't think you know a lot about my work. The viewers of this channel are systems literate and understand energy and commodities and materials as fundamental to our way of life. And we're concerned about not investments and returns per se, but how is society and civilization going to function ahead, where we're papering over some of these commodity and energy shortfalls and other things with debt and with credit and such. But we live in a biophysical world. So what do you foresee? I mean, we're talking about diesel and some of the 321 product shortfalls from Hormuz, but map on what you've said so far with a super cycle and some sort of a structural change in the world. What's the next decade going to look like?
You're going to rotate between the thematics of scarcity and debasement.
Yeah.
And I think those are the two big themes that are going to, and you got gold as your headline on the debasement, and I would put oil and copper as your headline. I actually throw in an ag like a corn or soybeans as the proxies for scarcity going forward. And I don't see how at this point how we avoid it. The underinvestment, it takes 20 some odd years to bring on a copper mine. And the oil, we haven't built refineries. One thing I struggle with in my more bullish products or bullish oil, you haven't invested in either one of them. And people go, oh, look at all the Brazilian and Guyana production coming on. Guys, that Brazilian and Guyana production was investment from the previous cycle. They're
Yeah.
I actually Goldman publishes these top projects of all the big projects that are produced. The last version was the first one ever that didn't have any major new projects. Because remember, sustainability, we were done investing in oil, just going back. So the underlying environment on scarcity, and it goes across the board because nobody ever thought we needed any of this stuff. And you can also look at the AI build-out. It's building all of this demand for metal, for energy, and for, turbines, for, transformers, which are all metal. Yet, nobody's invested in the raw materials used for all the build-out. So we have the biggest demand shock we've ever seen in commodities of this year, 800 billion. More than 50% of it goes directly into commodities, but no investment in commodities.
Yeah, AI is going to make this stuff worse. Although some people think we're headed to the tech singularity, we won't need all this energy and materials anymore, which is kind of ridiculous. I think you just wrote a piece, something titled like the abundance illusion or
Abundance
something.
illusion, yeah.
What's that about?
Basically, we go back to Carter, and Carter made a fatal mistake. He admitted the scarcity.
Yeah.
And he had two speeches. One was in February of 1977, and the other one was in April of 1977. And the first one in 1977, it was the famous sweater speech. He comes in with this tan cardigan and going, brrr. You can see the thermostat in the background, kind of like this one. And the response was panic set in. He goes, we need to reduce, we need to conserve, we need to do the right thing here. Okay, that didn't well. Prices of commodities go up more. People got scared. Then he goes out and he says, he coined the term energy transition in the April one. He goes, we need to invest in non-fossil fuels for security reasons. And so he was the one who brought out solar, wind, nuclear, and by the way, at this point, the French were already gung-ho. Nixon got it all up and started with Project Independence, but he gave the name energy transition, and we need to do it for security reasons. He called it the moral equivalent of war. What does that stand for? MEOW. Mistake right there. Meow is what they said, and they dismissed him. So what was the takeaway for the Western leaders? Never admit the scarcity, because he got killed. Second takeaway, the Chinese understood, you need to invest in energy transition for security. Because they did not take the energy transition seriously, and I'm not saying this in a way that's diminishing environmentalists, but the environmentalists were never ones that could take one of these policies and push it through, and we're still struggling. And so when it dropped into the hands of the environmentalists, it took on a political, let's call it, it became, hot potato politically. But I think the key issue is that what did the Americans and the Europeans learn out? It's this idea of abundance illusion. George Bush Sr. was the first one who actually ran into a war with Gulf War in 1991. Gulf War won with Iraq, and he used the SPR and he talked down the market. He did exactly what Trump did. That's the abundance illusion. And by the way, you're just playing a game. Can I keep this thing together until that supply comes back? Bush Sr. did it. Um, Clinton did it. Bush Jr. did it. Obama did it. Biden did it. And Trump did it. Every single one of them has done it. So what Trump is doing, Trump did not have to do it in Trump 1.0, but he had to do it in Trump 2.0. So that's the abundance illusion is you're making a big bet. You can avoid the real scarcity and never having to admit the scarcity because they all know how bad it ended for Carter. But before I continue, I just want to make another point about China. China heeded Carter's voice on energy transition. It didn't become the world's leading expert in nuclear generation capacity technologies, in solar, wind, batteries, lithium, the list goes on. It heeded that advice and invested in it. It had nothing to do with the environment, but everything for energy security. And it just demonstrated to the world it can roll with the punch. And I think when there's two aspects. The abundance illusion was the wrong answer. That's the route the West went because it's a political, I got to get reelected, and you never admit the scarcity. While the Chinese, which are, an authoritative dictator type of environment, made all the right decisions. And unfortunately, they're in a relatively good place right now.
I want to double click on China and electrification in a second, but regarding the abundance illusion, every once in a while, Trump drops a truth bomb that he probably is not supposed to say. But a few weeks ago, he said, if we hadn't done the MOU, we would have had massive shortages and we were this close to running out of diesel. I mean, he did say something to that effect, and then it was kind of brushed over. Any thoughts on that?
You notice he's been remarkably quiet this last week. Remarkably quiet. I think because he's trapped. I mean, by the way, if anybody's looking for somebody who's got the best read on this, Professor Robert Pape at the University of Chicago. He's phenomenal on this. It's the escalation trap. MAGA wants him to finish the job. They don't like this situation that they're in, because remember he made fun of Obama for giving them 1.7 billion, and he's now going to give him 324 billion.
Yeah.
And by the way, that number just got larger.
And by the way, the rest of the world doesn't like us because their products and their energy is a lot more expensive for other reasons as well. So I actually, again, you don't know my work and I know yours. I liken society to a superorganism, an economic superorganism that has a metabolism, and that we self-organize as small businesses, corporations, nation states to maximize profits. And those profits are based on energy and materials. And I think this Strait of Hormuz situation has splintered the superorganism, and over time, there's going to be an east and a west, and the supply chains and the global system is going to bifurcate to some degree. It's already happening right now. Let me ask you what your thoughts are on that, and then I'll get back to China and the Joules.
I'm gonna use a story of actually Robert Pape I think he's publishing this week in Foreign Affairs, where he talks about, actually it applies to the abundance illusion, that in 1991, when George Bush Sr. did the first abundance illusion, we went into Iraq 1. Two things occurred. The Soviet Union fell, is almost to that day. At the same time, he went to a war with 10,000 body bags and used 147. The victory was just astounding. The world was in shock and awe, real shock and awe, of the power of the United States. It became the global hegemon, and that globalization, that hegemony environment, it flourished. That was when it all took off, set the stage for China and everything. At the other end of the bookend is what we're going through right now. The opposite. Went in there with a big swagger and coming out with in a situation that is not as strong. And this was happening before this war, but at the same time, China is rising. So before, Soviet Union collapses, U.S. dominant victory. Here, China is asserting its authority to the world, really aggressively, by the way, and the U.S. had a very poor performance in the Middle East. Actually, the other thing we haven't talked about, they're at this point, they're burning through missiles. They shouldn't be using missiles anymore. The missiles should have been retired a long time ago. They should be using F-15s and F-35s dropping gravity bombs. You cannot fight $40,000 drones with $1 million Patriot missiles. And the radar systems are taking them out. This is getting dangerous. I'm not a statistician in military thing, but my understanding, talk to the people that do, is we've drained those missiles to such a point. We're in a very dangerous situation. So I'm a big believer that the period of globalization is ended. We're looking at an East, a West, a China bloc, a U.S. bloc. I don't know if it'll be a U.S. bloc when it's all said and done, but there'll be another bloc. And when we think about what that requires, and if we go back to the core thesis that we put forward for being bullish commodities, deglobalization and the war on free trade, when we launched the second supercycle thesis in 2025, was at the core. Because you need to build multiple supply chains, redundancy, new manufacturing systems, and all of that. And so this is really at the core of our bullish call on commodities.
Every one of the questions I have for you has so many rabbit holes that it could spend an hour. And but let me ask you this. So if there is a splinter in the world alliances and there's an East bloc and a U.S. North American bloc or whatever, on the one hand, that would be incredibly bullish for commodities because it's not one cheapest place to deliver global system anymore. And there's going to be some sort of a Liebig's law of the limiter on some commodities somewhere. But on the other hand, it's incredibly deflationary because the dollar, the petrodollar, the global credit system, if we run out of money, we just vote another increase in the debt ceiling. Credit also has a huge role in commodity pricing. And we just assume that if we run out of stuff, we're going to print more money as a sovereign. But the global economic system has been a Wile E. Coyote climbing higher and higher. So how do you see the relationship between, obviously commodities are getting less quality, further away, more demand, scarcer, therefore the price is going to go up, but our affordability and access to them is also dependent on credit. What are your thoughts there?
There's two answers to this. I want to talk about it. What does it do to commodities as a liquidity provider, but also let's talk about the end-use demand. Clearly, when we look at the group that consumes the larger share of commodities, and this was the second big theme, it's called redistribution, is the only way you deal with this is you got to give money to the lower incomes. They don't have credit. The credit is for the middle to higher income groups. And in fact, when you look at the quintiles, the bottom two quintiles have zero credit. And they live paycheck to paycheck. So you hit them with fiscal transfers. And by the way, the U.S. is in a very, very serious situation right now because that K economy is just getting more extreme and more extreme. And when you hit them with the fiscal transfers, it is very inflationary. We saw that with Biden. He gave him the $2,000 checks or whatever it was, and boom, the price of commodities exploded. And this is one thing I realized at this point, contrary to what anybody will tell you, and the macro guys still argue me on it, inflationary is caused by low-income people, and it's bad to high-income people, even though 2022 proved that out. The high-income guys lose their wealth. It gets taken from them from the fiscal transfer, and then the inflationary pressures of the fiscal transfer end up hitting the high-income guys' wealth. And by the way, everywhere, whether if it's Venezuela, and the thing that I realized, you cut interest rates for 20 years, inflation never materialized. You do fiscal transfers, and you're off to the races. And I don't care, every single environment of inflation since we created fiat currencies has occurred via that mechanism. socialist governments providing big fiscal transfers. Whether if it was in Italy in the 80s or Latin America in the 80s, Brazil in the early 2000s, just the list goes on. It's over and over the exact same formula. And think about this too, is if the price of a commodity goes up, it has to be a low income player because think about it, some high income guy. He's going to consume the same amount of corn regardless of where he is in the cycle. The only guy who will increase his demand for corn is going to be the low income guy when you give him the fiscal transfer. So when I think about, on this thing, and everybody goes, "Oh, that's not true. The low income guys are made worse off by inflation." No, they aren't. They got the refrigerator in 2022. They got their whatever they spent their $2,000 on. They got it. Yeah, after the fact, it was bad, but the high income guys paid for it, and then they got hit by, I think it was a 27% drawdown in the S&P. So, but what did the U.S. do? Print more money to get out of it. And so that's point one. If we think about point two, the liquidity, if you ask me why have commodities not gone up, is they don't have any liquidity. It's too hard to get credit to trade. This goes back to your point about, the back end having no liquidity. Back end has no liquidity because Dodd-Frank shut them down. It created an environment which it became open interest, and a lot of these markets have gone down. So when we think about that price level, your physical consumption, those end-use things can drive up the front end, but the liquidity that creates that price level that clears is a function of the availability of credit, which while there's a lot of credit for things like AI buildouts right now, there's not a lot of credit for anything else in the global economy.
So thank you for that answer. You looked at within country part of my question. I was more thinking about the U.S. itself with international creditors and the over-leveraged international financial system where currencies are in a race to the bottom against each other. But the real currency that we're measuring them against is net energy or the high quality energy available after we've spent the cost on energy and mining, et cetera. And if that system is disrupted, that would be the mother of all deflations, at least temporarily, then followed by hyperinflation because global supply chains would be disrupted. Do you have any view on that broader macro perspective?
You mean actually take me through it again so I understand why. How do you get the deflationary pressures?
We need money to pay for things, and sometimes affordability declines faster than the depletion of the commodity, and then we get deflation. So I'm just saying that right now, Japan and China and others own U.S. debt. We're spending so much on military and helping the bottom two quintiles, and we're printing more and more money. You can print money, but you can't print energy. You can only extract it faster. So at some point, interest rates will go up to a point that we won't be able to borrow as much. We won't have access to as a country. And I don't even think it's going to happen in the US first. I think it'll happen in Europe first. France and Germany, they're going to have a huge import bills because of natural gas and other things. And eventually we cannot borrow more because we lose our creditworthiness. So I think that becomes deflationary much the same way that 1929 was.
Let's talk about the exorbitant privilege, because that's really what drives that access to credit for the United States. And let's talk about the grand bargain that sits behind it, which is Bretton Woods in circa, 1945. It was, the agreement that the Americans had with not only the Allies, but with the Axis powers. And it was a deal in which they created the World Bank and IMF, and the World Bank was put in place. We're going to give you money to reconstruct. We're not going to occupy you. In exchange for that money, we expect you to use the US dollar, funnel it through New York, and we will use our big, massive Navy to protect global sea lanes. And still to the day, if China imports copper from Chile into Shanghai, United States is the one that protects the Pacific, protects those global sea lanes. And that has a high cost to it. And that's part of what Trump is complaining about. Remember when he wanted to put the 20% tax on oil going through the Straits of Hormuz? Oh, he's nuts. No, it's really expensive to fly all those planes and protect all of that. He wanted to get paid for it. Whether or not he did it correctly, I think that's another question, but it's really expensive. So when the United States came out of the Second World War, it was like 95% of global's industrial production. It had it all. It made sense then, but we're 80 years later and we're still doing it. So that's the setup. That's called the grand bargain. Now let's apply that to the strength of the dollar in the United States. Because the US is that protectorate of global sea lanes, free trade and globalization and everything, it gets that exorbitant privilege, and all that money flowing in, chasing AI and the rest of it allows Americans to consume at a level that's never been achieved in the history of mankind. And that all comes through credit. That credit is going to dry up if that exorbitant privilege gets broken, which is why it's so important for Trump to go in there and free that Straits of Hormuz. Because if he doesn't, he loses that exorbitant privilege, because isn't the grand bargain, I will protect global sea lanes for all people if they trade and use the US dollar. So here we are. Now we have 3 sea lanes blocked. We have Red Sea, Straits of Hormuz, and the Black Sea all blocked. So where is the global protectorate to open up those sea lanes? By the way, I made the point in a piece we did called a new Marshall Plan, and that's MARTIIL, Marshall Plan, where it didn't matter who was the president. Once interest rates went higher, it was too expensive to maintain that system. And so when we think about that ability to have that credit, I think we really got to watch what's going in the Straits of Hormuz. Trump, if he doesn't do, which is part of the reason I think he went back, he knows he'll break the grand bargain if he doesn't free open that sea lane. But the Iranians also knew it. So the importance to this for the United States is, let's do Robert Pape's point. It's the 2 bookends of globalization. But if he cannot protect all of those allies and everything like that, he broke the grand bargain. In that last 80 years, we're moving into a different world. Now let's go back where people start pulling their capital out of the United States because they don't trust them anymore. That's going to hit middle-class America and change their lifestyles like they've never seen before.
I expect that's reasonably likely. I want to talk to you about different commodities in addition to oil, and also get back to China. But since we're on the grand bargain, I mean, you're an energy and commodity expert, not a geopolitical expert per se, but paint me a picture. What is the best case, worst case, and most likely case of this situation in the Middle East? But you mentioned 3 places, resolving in the next year.
The situation here is that I don't think is widely said is this is BRICS versus G7, even though the Europeans don't know they're involved.
Yeah.
And if you're BRICS, you're going, hey, for the last 400 years, you guys have treated us like dirt. And, and by the way, I don't want to get in who's right, who's wrong, the politics, but, you ask guys who are like CIA experts and stuff, they're going to tell you all Putin wanted was respect.
Yeah.
By the way, the Iranians were never really they had 47 years to develop atomic bomb. All they wanted was respect. I'm just telling what it is. I don't want to offend anybody here. I'm just repeating what any intelligence person will tell me. Chinese wanted respect. What the British did to them, the Americans, they're upset. And from my understanding, those 30 days when that straits was open, there was not oil tankers going back inside there. Those things were container ships with military hardware. The Iranians, they're playing a different ball game. It's like I look at this, I go, you take China. China controls the world's critical minerals. Why? Because Americans, Europeans, and by the way, I learned this from the Soviets. The Soviets told me, even the Soviet Union didn't want this stuff in their backyard because it's polluting, it's toxic, it's terrible. Let the Chinese do it. Chinese will do anything. That's what the Russians told me. And so the bottom line, Americans, they buy all this stuff from China, and China's producing this stuff, making their environment toxic, and they don't care. And by the way, it was like in that whole period about with the sustainability, nobody changed their behavior. They just dished it all off to China. Let China create the emissions. We feel good about ourselves, but we keep buying the stuff. And so when we look at the situation, they process everything because the Americans won't, the Europeans won't. The Russians did it to a lesser extent, but these decisions were made between the 70s and all the way up into the 2000s. Now there's none of it. Okay, so you look at the Chinese, they control the world's critical minerals. Now, who are the two biggest backers of Iran? Russia and China. And we know that by looking at the equipment and the intelligence and everything they're getting on this. And now, what do the Chinese control? The world's molecules. So they control the world's atoms, they control the world's molecules, and also the Strait, Taiwan to get them into Taiwan. Then they control the world's chips. So I look at this situation. This is not just what's going on in Iran. Is, by the way, you have Ukraine striking deep into Russia. I don't want to get into military things about, are we in the Third World War or whatever. I'm looking at this thing. We have got fronts all over the world at this point. People are making the point that, even some of the people in the intelligence community are backing away. Hey, we didn't tell them to go do this.
Well, my understanding is they told him not to do it.
Yeah, that's my understanding too. But
yeah. And what's the worst case?
Worst case is one of these actors, meaning either Putin or even the U.S. Uses some of the types of weapons we don't want them to use, and because everybody's going to be pushed into a corner, and but I think let's take out the nuclear bomb option. Let's go to what I think is the worst case scenario. And I think this could happen very shortly because Putin's in a really precarious situation right now. I don't know if you've seen those reports about it in that. Let's say he just goes, "I'm done. Let's just shut the world off with all the critical minerals and everything." Remember, they are the world's largest commodity. When you look at all the things, the U.S. is the largest energy, but it doesn't have metals. Russia has both metals and energy. China has metals but no energy. So those are your three largest commodity producers. Two of them are Russia and China. So, their ability to choke off stuff to the West, which just shut down big industrial processes. So your worst case scenario is not too far away. And I think it's I wouldn't say it's a non-trivial probability one of them does something like that.
I agree. Let me bring in another commodity that, again, this is July 23rd. My understanding is that Ukraine, which really means the U.S. and England, are targeting Russian food supplies and wild berry and other things. My understanding is that Ukraine and Russia together account for 20% of global grain, and the Odessa ports are now effectively shut in. Irrespective of the fertilizer, which is a 2027 story, I think, what about the imminent impact on grain if, let's just say, half of that comes from Odessa, so 10% of global grain is shut in? I mean, what are we seeing on the food side of things?
You forgot the El Niño. Throw that in there too.
Okay, yeah, throw that in too. My gosh.
I was in the Mediterranean yesterday and it was 46 degrees. In fact, I sent my daughter back to London. And the reality is that this was every climate forecaster was telling you this El Niño is serious. Now you put that on top, what kind of damage it ends up doing to the crops this summer, and the harvest is late September, October, and we'll know you're going into your hottest period is around middle of August. So we're going into those hottest periods, and if it's 46 degrees where I was yesterday, you can only imagine how hot. Those of you listening that are in places like Dallas, Texas, you've dealt with the 46, but there's very few people out there who actually deal with 46. So we're moving into some really hot weather. And so you combine that with what's going on in the Black Sea. which, at this point, they're hitting them hard, whether if it's it's the whole ports. It's whether if it's oil, grains, or whatever it means. So you're losing that, then you have the fertilizer shock for next time around. I that's the reason why I own the indices. I own the whole kit and caboodle across all the commodities. It's not just an oil story, it's an ag story. It's a metal story. The upside on agriculture, I think, is significant. And then the other thing too is when you're in an environment in which you have a strong dollar, which the dollar has been strong over that whole time period, incentivizes all those Latin American countries to grow acreage as fast as they can and export as much as they can. That thing's ran its course too. By the way, the agriculture markets, they're moving, so it's not like they're being complacent about this. They took a step back after that MOU, but they've gone right back up when you look at the broader agriculture indices.
A lot of things we're talking about are the nominal first order effect of some sort of energy scarcity, that prices go up. Prices like diesel, the crack spread is effectively pricing as if oil was $160 a barrel. But what would be the second, third order effect if there is persistent diesel scarcity? What would that do to food and freight and the productive economy beyond what shows up nominally in the financial prices?
Let's go up with, the why every president after Carter, I guess after Carter, actually Reagan didn't do it, but from George Bush Sr. onwards, did the abundance illusion because what Carter created was hoarding. That's this next round of this. And if I go, what did I get wrong in March when my biggest fear of this thing was hoarding? Because we were seeing it in metals because they were fearful that the Chinese were going to cut. And that's part of the reason why silver went up as much as it did was hoarding, but actually by the Chinese. Um, so I would argue that if this thing gets to the point people don't believe the administration has control over it, hoarding, I think, could set in. And there's a high level of confidence about how Americans' energy dominance. It's not like it exports because it imports a lot. Let's just
Yeah,
look at the numbers. It's
on the
not
oil
like
side.
on the
Yeah.
oil side. Gas, it's relatively long. But by the way, transportation fuels and gas are not the same thing. They're not even the fungibility is very, very low. And then from an oil perspective, the United States is not that long. In fact, if it didn't have Canada, it would be short, particularly on the black oil side. So the hoarding effect could become more serious.
And are you talking hoarding within countries like the US or globally, internationally between countries?
I think it would be internet. SPRs are between countries, and individuals are in countries. I think the next response out of the US would be to ban exports of product,
Yeah, I think that's coming.
and that's another form of hoarding.
So we've talked about the U.S., which is where you and I live, and we'll come back to that. But other countries are also in the crosshairs here. What about Europe, who doesn't have the energy abundance of the United States? They also don't have their own sovereign per se to print money because it's a union of different countries. How does Europe look ahead with this energy kerfuffle in the Middle East and beyond?
I'm bullish on Europe, and let's just go over every. What did the EU achieve? The EU was put in place to avoid any entity having a power over the other one, and it was all about consumer protection. US and China are about producer protection. The US and China are in debt up to their eyeballs. Take the UK out because it's somewhere in between. Yeah, when we look at the German-speaking Northern Europeans, put Europe as they're 81% GDP, debt to GDP ratio. United States is at 125. China's nearly 300. So Europe is not, on a debt to GDP ratio is not bad. Income equality. And by the way, I live in Europe. I don't live in the United States. I live in Europe.
Oh, okay.
Let's go back to the debt to GDP ratio. And then the other factor that's really important about Europe is they have much greater income equality, and then they have consumer surplus. They protect it. So their starting base is a very good one, and they have a rule of law, which also capital likes. Now let's talk about so that's their setup, and they don't have War Kit 1.0. War Kit 1.0 was just proven it doesn't do much between Russia had 1.0 and War Kit 2.0. I say War Kit 1.0, that's artificial muscle. That was the oil-based War Kit. War Kit 2.0 is artificial intelligence. That's drones and AI. And so when we look at War Kit 2.0, it's very, very significant. And so if I'm Europe, I'm going to be spending 5% of my GDP on a new war kit. And now let's go, what, we look at what does Europe have on the energy side? Massive amounts of actually, the French have the nuclear capacity. The Germans have the renewables. There goes, probably all you guys are telling me, oh, renewables don't work. I agree. Renewables don't work unless you have batteries. Now, what did we learn in Iran and we learning in Ukraine? The big refuelers, the planes, the boats, they're just a sitting target for drones. They're just too easy to take out. Remember I was talking about you can't take those petroleum ships through the strait. Now you imagine a plane flying around with jet fuel or diesel or something like that with the drones. Drones can take out B-1 bombers, 400,000 drones versus the B-1 bombers. The B-1 bombers are done. And so when we think about Europe, what did we learn from this war? It's battery technology. You have to have battery technology. And what is Europe missing? Battery technology. And so at this point, the race is on. And people like that in the environmentalist community, they go, "Oh, I can't believe that the defense guys are getting all the budget." And I turn to the environmentalists, I go, "Who created all your technologies? Defense. They don't
Yeah.
ever get what does that say? Necessity is the great innovator,
The mother of all invention.
invention. And we're at that point. It's the first one who can get battery technologies. You don't need those big refuelers. You want small batteries you can conceal from the drone. So the race is on for batteries. And if Europe can get the batteries, and also let's go back to AI. Which of the three big companies, NVIDIA, ASML or TSMC is the most dominant one? Well, who has the biggest moat? ASML has it. That's the Europeans. And so even in the AI race, the one with the dominant, most biggest moat and powerful company are the Europeans. If they can get battery technology to fuel all of those renewables, because I agree with anybody who's being dismissive of the Europeans with those renewables. But if they have battery technology to go with it, boy, they're in a different ball game.
You've brought this up a couple times on electrification and batteries, and you, I believe, wrote a big paper recently called the New Joule Order.
Yep.
And your framework for our era, if I paraphrase, is that a security premium on energy has replaced the green premium, and that electrification is the purchase of optionality, and that China is way decades ahead of the West. And you said that if Europe has batteries to pair with their renewables, that's a game changer. But I want to press a little bit on the core premise, because at the point of consumption, you argue that a joule is a joule, and we both understand how important energy is to our economies, but joules differ in quality and in density and in storability and transportability, and aviation and shipping and steel and cement and fertilizer all depend on specific hydrocarbons as a fuel and as a feedstock. So how do you account in your framework for a reasonably large share? I believe around 20% of the global energy use is electricity right now, a reasonably large share of the economy that might not be able to be electrified, and therefore all of the renewables produce electricity, and the stuff coming out of Iran is liquid hydrocarbons. So there's a quality differential.
And I agree with that, but here's the difference. is, let's say you get to 80% electrification. That's what you're talking about on there.
Well, no, right now we're at 20%.
Right,
You
we're
think
at
we can get
20,
to
but you
80%?
can get to 80 if you just leave the stuff like cement and you know, jet and those things. They're not that big. The core of this is still transportation fuels, and then gas going into turbines and things of that nature, and coal. Remember, coal is still the dominant hydrocarbon here. Now, the point being is coal, gas, and oil have a marginal cost of consumption. Renewables, batteries, and nuclear power have 0. And if I'm China, and if I can, and the AI race is really an energy race, and I can dominate all my electricity being produced at 0 marginal cost, it's game over for the rest of the world. Because remember, the stuff you put up front is sunk cost. Somebody else paid it. The guys in the future don't have to pay it because the guys in the past paid it. And so when we look at, like, you listen to, and there's probably people on the listeners will tell me, but Jeff, the gas-fired generation capacity is so much cheaper than the renewables of the battery. Yeah, I'll, maybe it's by a factor of 7. I don't know. Does China care? No. They're going to keep going because they know once they have it, they may spend tons of money getting there. The marginal cost is 0. Versus the marginal cost to do that coal-fired generation capacity in the U.S. is, what, $3 an MMBTU? It's a big difference. And so, and then everybody's consuming their data centers, their LLM models and the rest of it, and their robots are being driven by 0 marginal cost. This is like when the Americans built the railroads between the East and the West, Pacific and the Atlantic. It was game over for the rest of the world.
So can you envision a future scenario, given all the constraints we've already discussed, where the peak demand thesis on oil is actually somewhat true, that we don't need liquid fuels 10 or 20 years from now because of these other things?
Absolutely, where China is going, and if you look at could we end up with a world where we have the petro states and the electron states, and that's your separation, like the old East-West? Yeah, I think we could end up with that way. Actually, watching Ukraine and watching Iran in the last 6 months, I've come to the conclusion, you gotta ditch the petro state. You gotta artificial muscle was what oil was. It was artificial muscle. The
Yep.
artificial intelligence is just like, from my understanding, just in the last couple of weeks, you got these drones sitting on these fiber optic cables. I guess there's fiber optic cable coming out of Iran all over the place. You're not gonna win a war where you have a $1,000,000 Patriot missile used to take out a $40,000
No.
drone that can turn by the way, the reason why they have it on the fiber optics is because in Russia, they were having to shut down the banks and everything to get the Wi-Fi off because the Ukrainian drones would use the signals off of the Wi-Fi to keep going, and so when you hear these things, they just shut down the internet, and then the drones come in, and you're getting swarmed. And so the ability to have artificial muscle, something that could smash it all up, that it's just that technology is no longer, actually, here's a stat for you. It What horsepower, think about, that's what artificial muscle was, horsepower. The constraint on automating stuff was never that. It was constraint was cognition. And so we only automated, or 20%. There's another 80% left to do now that we've unleashed the constraint from horsepower to cognition. So the amount of things we're gonna mechanize and do all this stuff, and that's batteries, that's electricity. And so if you would have asked me that question, Nate, 6 months ago, I would have had a very different answer. But just in the last 4 weeks, watching what Ukraine is doing and watching what the Iranians are doing, which is really Russia's learning from the Ukrainians, who then bring it into Iran and use it against the Americans. So I think it's just it's just a different ball game, and I can't even process how quickly it's changing right now.
How do you stay on top of all this? Obviously, you have a lot of contacts and you check in, but it's a whole encyclopedia of topics that are converging here.
My wife complains I'm on the phone too much. I literally, the one advantage of sitting at Goldman for 3 decades was the being able to talk to people,
Yeah.
and it's just sitting there talking to people who are sitting in there in Doha, like, on Sunday, telling me about, "Oh, yeah, I just had one that come from 3D computers fall through a ceiling, one of these drones that the Iranians were, and he's looking at the thing going, "Okay, yeah, it's got this and that on it and everything like that," but it's that information flow is just it's becoming faster and faster.
But to get to the cognitive helpers, we're still going to need the artificial muscle from fossil carbon to build the data centers at the scale that is required to keep up with China. And that itself is going to be a huge demand for commodities, as I think you mentioned earlier. How's that going to play out?
Oh, I think we're gonna run into real shortages as they try. Here's the point I say, of that 800 billion, all of it's gonna go into the price of copper. Or I'm being exaggerative here, is that, as they continue to put more and more pull, and you already see it happening. The human beings are renewable resource.
Yeah, I say that too.
Copper and energy are not. And we're gonna try to change humans into a non-renewable resource base. I just don't see just this simple math says it's gonna be more expensive. So they better be doing some really important tasks, that they that because they ultimately are gonna end up costing us a loss, and we're gonna be more material into them and things of that nature than what we did before. But here's the way I like to think about it. The old technology data stuff, that was infinitely scalable at zero marginal cost, like software. I publish it, send it to, I create it and then roll it out all over the world. And that's how those companies became so profitable and so dominant. Now, they're in good old fashioned putting steel in the ground type businesses, systems that a lot of you guys are probably all very familiar with. It has an upward sloping supply curve. The more you do, the more expensive it becomes. And so I think what's gonna happen, and you already hear it and looking at the by the way, I see it on I use Claude, and I use the max version. My thing spins all the time because I run into the constraints. There in London, it would run into power constraints on a regular basis, but the reality is that, you're already feeling it, and you're hitting that physical floor on the cost of doing this thing and your tokens and running out. Eventually, people and ultimately, the fact that it's a fixed fee and not a, pay as you go like your cell phone, which is means we're gonna quickly move in. They wanna get you addicted at the fixed
Yep.
fee, and then they're gonna move in, and the cost of this thing is gonna explode.
That's one of the deflationary risks to a bullish commodities scenario is that we're building out all these enormous trillions of dollars of credit and the hyperscalers and all these things. And if society can't afford what's required to keep those companies profitable, there may be an AI winter sort of scenario. I mean, I don't know that for sure, but I see that as a potential risk.
Oh, I think the valuations of these companies, 40% of the S&P, you listen to anybody that has been around these markets, this is like a very precarious situation we're in
Yeah.
right now. What's gonna be bad is for the governments, not for the companies. I think those overvalued companies that are sitting there, those, that like Google, they're gonna experience like what the oil guys experienced in 2014. Yeah, it's gonna hurt. It's gonna be painful. We've all seen it. We're gonna get through it. It's not that bad. But let's go back to your point about the US and the sovereign credit. Where is the real imbalance sitting? The real imbalance is sitting on the US government balance sheet. The real balance is sitting in the UK balance sheet. The real balance is sitting in the Chinese imbalance. Blah, 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 list goes on. All of these sovereigns are in a really precarious situation. Yes, Google is not as good as off if it was better. It's going to pay a price to it. All the too much money went in. Two investors got too excited about it. I don't want to get into it, but it's not going to be. You've seen it before. I've seen it before. We're going to get through it. It's going to level it out, and they'll smooth it out over time. But I think that what's happening at the sovereign level is very, very, very more dangerous. It's far more dangerous.
So you mentioned earlier about what China's doing, and they've been building excess capacity on energy and systems for a long time. And I think you've written that the West may now have to build its version of such a system under duress, at a crisis cost, and from a depleted, diminished strategic position. So, what does building under duress actually look like? And what might we have to sacrifice because of that precarious position?
China's cut back all critical minerals, and we don't have any access to it.
As one example, yeah.
We've exhausted the SPR, and we need a lot of energy and diesel. In fact, diesel is where the shortage is now.
As another example, yeah.
Another example. We need to, we're out of turbines to be able to get the power generators to really kick up the demand for the data. I think the other thing too is about on duress is the technologies we're making a one-sided, one horse pony bet here on the AI is that we look at China. China comes out with a whole new technology. It's more energy. And the consumer's going, hey, why am I consuming this one? I can consume that one at a fraction of the cost. There's a lot of pitfalls here that when I talk about duress, that can make this a much more difficult. The other one is, what if we're in a full scale, war or something like that?
A lot of your clients and some of the people listening to this program want to know where to invest their money. And obviously, you're laying out a case that commodities, especially oil and copper, are going to be going up in the future.
Gold.
But
I'll put gold into that list too, longer term.
where I was going was we live in a society that has governance and innovation and people. So, financial predictions aside, what kind of policies and actions are you hoping to see governments, the US, the UK, and leaders pursue as our systems enter this period of recalibration in terms of our expectations for physical goods and the reality of their continued availability? What should we be doing, people that are in those spheres watching this show?
I'm a Chicago trained economist,
I
very
won't
much
hold that against
big
you.
and I'm gonna say this, and I don't wanna come across it, but I think state capitalism is back.
What does that mean exactly?
It means that you're gonna have to put a lot of money. States are gonna have to back these things. They're 27-year duration projects, to really move. And why is China moving so quickly and doing this is because they just go in there and they do it. They back it, So the fact of having a state-sponsored capitalist model where you're going to help finance quickly. Because think about what was World War II when the United States could just build all that stuff? It was state capitalism. It was going in there and turning, auto plants into weapons plants and things of that nature. I don't know where we're going to have to go, but here is the core problem. It goes back to where we started this discussion, Nate, was people don't like the space. There's not a lot of money in it. And the
Yeah.
reason they don't like it is because it takes so long to build out, and it's not gonna give you the home by the way, it's a relatively stable return once you've built one of these things. It costs billions and billions to build it, and like, take a copper mine. It's gonna take you, decades to get that thing built. Investors do not have the tolerance for that long of a duration project. Um, and then the cash that comes out is more short-term, yielding. So it's a very they're not they're very difficult for investors to swallow relative to other types of investments.
So, said differently, the financial market participants are not likely to invest in and build the societal infrastructure that we're going to need in coming decades, and the state is going to have to intervene.
Unless we can come up with ways to extend the duration. And it goes back to let's go back to 3% of the S&P is energy, 3 to 4, somewhere in that range, and like 1.5 is basic materials. Too small.
And 3% of energy is like 95% of the floor of our economy runs on energy.
By the way, I also want to make it clear to leaders why I think peak oil demand is going to be happening much sooner than I think people have. I think once this discussion moved out of environmental and went to security, I think it's going to get turbocharged and happen for real. But but I think, thinking that I'm arguing peak oil's tomorrow, no possible way. You still need to invest a lot in oil to keep the system going. It'll take you years. But the one thing that will change, I think the battery technology, now it's in the hands of defense players, will get there a lot more quickly.
You were referring to the demand for oil, but what about the peak oil supply?
Oh,
That could happen.
that may be already on top of us, which
Yeah,
may
exactly.
force this way faster because
Exactly.
we don't know how much damage we've done to Russia. So if you've done damage to Russia, we don't know what's happening in the Middle East at this point in the game. If you took out Russia in the Middle East, well, folks, you better learn how to make those batteries really quick.
Or plant potatoes.
Yes.
I want to be respectful of your time, and I have a few closing questions I ask all my guests, but I want to do one more oil question. What's the truth and the reality of the Strategic Petroleum Reserve in the U.S., and how close is that to being an issue?
The numbers I was given before the government published their 70 million barrels, and this was done right after the Biden administration drew it down so much, was somewhere between 270 and 300 million barrels. And let's remember, as you pointed out in this discussion, Trump himself said we were getting close to the bottom. But the Department of Energy just published 70 million is where you can take it down to. I'm going to stick with the original 270, 300. And Amos Hochstein, who, was Biden's energy guy during that time period, he said 300. He lived through that and watched it firsthand. So the 270 to 300, engineers have published it. I think we're getting close to that. And that's part of the reason why that MOU was signed so quickly. So I think, it's something that's coming up close.
But what happens when we get to those numbers or below?
The caverns cave in on them.
And so then we're back to whatever we're producing from the wells and being refined, mixed with Canadian and Venezuelan crude. So this is the moonshot in product prices were that to happen.
Yep.
Yeah.
So that the risks are quite high when we get to that point, and that's when this thing can go a lot higher.
I will make a prediction publicly right now that you are going to be a very busy man the next 6 months.
Yes, I have to agree with that one.
So, what can someone listening to this episode do now, today, this week, this month to help address some of the risks that you discussed in this conversation, or is it all up to politicians and leaders?
My guess is most of the people that listen to this understand this and are frustrated as well as I am at the inability. I think it goes back to the point. It's really at the core of this is how do you get somebody to move away from something that 53% of the S&P that's going in line straight up, they're all making money and go, hey, go buy this volatile thing that's 3%. That's what needs to happen here. And you have the abundance illusion that the Western governments are pursuing that, make it more difficult. And in the op-ed piece, I said, I called it the paradox, the physical capital paradox. And I asked, why won't they? By the way, the free cash flow yield at the energy companies is 15% right now. I call it the munificent. Munificent means gifting lavishly. Munificent 7. Why aren't people putting money into it? They won't. It wasn't the great returns in the 70s that got people to put money in the space. It was shortages. It was lines. In the 2000s, it wasn't people seeing that, metals are a great thing. By the way, those BHPs, these things went up 50x. It was they saw the shelves of the warehouses get empty. People don't buy these stories until you run out, and then that capital flows. So I don't know if there's much we can really do and watch it and be frustrated, because I think many of you are like myself, and I think it will take the actual shortage to get people to move, and then we get the capital move, and it's a different ballgame.
Ex-head of the CIA and Secretary of Energy James Schlesinger, who gave me a hug once after one of my talks, famously said America has two modes, complacency and panic, which is kind of what you just said.
Yeah.
So you mentioned you have children. What specific recommendations do you have for young humans in their teens and 20s who become aware of some of these constraints and El Niño and all the things going on?
The number one thing is that I tell everybody is just make sure you understand AI and become AI literate. And, there's apps engineers and things of that nature because the questions and you can prompt it. I catch myself up late at night talking to Claude and learning things and understanding. If you guys are all systems people, I think you're probably guilty of that as well. But I think, the best advice is just be incredibly literate on A, 'cause if it gets ahead of you, your ability to catch up it'll be incredibly difficult, and so it's like I deal with people some of my age, and they don't subscribe to the max version of this stuff. Subscribe to the max version of this thing and use it and become completely aware of it, and, with my daughters, it's like we sit around and we use it with them all the time, and, it's just I think it's, falling behind in this technology will be very dangerous, not only helping out the issues that we're seeing right here, but more broadly, and it's a wonderful tool, and we should be using it.
I do predict another prediction that there's going to be a bifurcation in society, those people that follow your advice and those people that find that advice abhorrent for whatever reason, and the people who use AI or can afford to, and the people who don't is going to be a bifurcation in society, I
Yep,
think. Yeah.
yep.
What do you care most about in the world, Jeff Currie?
I care most about being connected with other people and making sure we make decisions that are gonna make the world better off and in the future. If we sit in vacuums and don't communicate with each other, and you're asking me, "Why do I sit on the phone all day?" And being connected is just understanding and helping, bring that information and being aware of what's important and trying to make these right decisions, so
I love that answer. I'm the same way, and my girlfriend complains all the time that I'm on the
I
phone.
like to hear it.
So if you could, this is maybe an unorthodox question, but if you could wave a magic wand and there was no personal recourse to your decision, what is one thing you would do to improve the future?
Yeah, I don't wanna sound like the environmentalist, but I look at our planet and, they're all tied to the same situation, is just creating an environment where we live in a way that respects the place that we are everything we're given so that, when I look at I have a 22-year-old and a 3-year-old, and my 3-year-old, I look at her every day, and I wanna make sure she has, a world that's safe and secure, and part of the reason I had to see her leave Spain, 46 degrees is in an environment that's just not healthy, right? She was passed out on a couch yesterday. So she's back in London where it's cooler. And that's kind of frightening.
It makes me happy to hear you as a Wall Street icon say that, because I think the planetary boundaries, not just climate, but all of them are not really on the checklist of most people in the financial industry. And I fully agree with you. It was great to meet you. Thank you for your time today.
Yeah, Nate, it was a pleasure. A lot of fun.
Make sure and get some rest in the coming months. We're going to need your brain and heart.
And I'd love to do this again sometime. It was quite a pleasure.
If you'd like to learn more about this episode, please visit thegreatsimplification.com for references and show notes. From there, you can also join our high-low community and subscribe to our Substack newsletter. This show is hosted by me, Nate Hagans, edited by No Troublemakers Media, and produced by Misty Stinnett and Lizzie Siriani. Our production team also includes Leslie Batlutz, Brady Hyen, Julia Maxwell, Gabriella Slayman, and Grace Brunfeld. Thank you for listening, and we'll see you on the next episode.